The main issues that arise in relation to capital gains tax planning for an estate plan are the level of capital gains that will be triggered on death. In simple terms, there are no capital gains tax consequences of death, but practically there can always be complications that need to be considered, and often specific specialist advice will be required. Also, personally owned assets that pass under a will generally enjoy a specific exemption from any capital gains tax. This means that in relation to assets that are acquired after the introduction of capital gains in 1985, the beneficiary will inherit the asset with the exact same capital gains tax cost base that the will maker themselves had. In contrast, for assets that were acquired prior to September 1985, the beneficiaries will actually inherit those assets with a cost base equal to the market value of the asset at the date of death of the will maker. Some of the other areas that can lead to complications from a capital gains tax perspective include, firstly, where assets are owned by overseas beneficiaries. In those instances, the rollover for capital gains tax and exemption that would otherwise apply can often be unavailable. Similarly, where assets that are passed to a testamentary trust, there can be a denial of the capital gains tax rollover in certain factual scenarios. Indeed, the exemption for capital gains tax that applies to personally owned assets that pass under a will not apply in relation to assets that do not themselves form part of the personal asset portfolio of the individual. These assets include ones owned via trusts, superannuation and private companies.